All right, we're into day 40 of the longest government shutdown in American history. In various ways, it's affecting hundreds of millions of people's lives, livelihoods, and personal and household finances. It's affecting tens of millions of people's ability to simply put food on the table. 42 million people who rely on food assistance from SNAP are suffering, as we've been discussing for the last week. Roughly 670,000 people have been furloughed from their jobs, and roughly 730,000 more are not furloughed, but they're working without being paid, which is on top of hundreds of thousands of people already fired from the government since Donald Trump retook office. Prices are up and rising, due in no small part to Donald Trump's tariffs, and there are signs of an increase in layoffs and a weakening labor market, which we're seeing through private analysis and not from the government, because the data is not coming from the government because of the shutdown. That said, the stock market is up. The Dow is up almost 10.5% since the start of the year. The S&P 500, which is probably more reflective of your retirement investments, is up almost 14.5%. For the S&P, the driver of a significant amount of those gains is just a group of 7 stocks. They're called the Magnificent Seven. And because of this, there's a bit of dark undertow lurking beneath the waves. Now, whenever there is an important and complicated matter posing a major threat to the overall health of the U.S. economy, there are a couple of people I really like to talk to. And luckily for me and all of us, I'm joined now by 2 of them. Caleb Silver is the editor-in-chief of Investopedia. Justin Wolfers is a professor of economics and public policy at the University of Michigan and the senior fellow at the Brookings Institution. He's also the co-author of Principles of Economics. And I'm going to get Justin, hold tight for a second, because I want to go through some charts with Caleb and just illustrate what this Magnificent Seven is. Magnificent Seven, Caleb, are tech companies that are largely leaning into, for other reasons also, but they're leaning into artificial intelligence. I wanted to show people a look at a chart, a graph of the S&P 500, and then the S&P 500 without the Magnificent Seven, and with the S&P 500. Let's take a look at that. The chart, please, if we could. Right. Okay. So the purple line at the bottom is the S&P 500 since 2023. Pretty good. It's up 75% since 2023. The Magnificent Seven alone, 7 stocks, 315%.
Yeah. We're living in the land of giants, Ali, and this is a perfect example. Those companies, and we're talking about Nvidia, Apple, Microsoft, Alphabet, some of the biggest companies in the world, have been gaining a lot since the commercial release of ChatGPT. Roll the clock back to November of 2022. That's when this real bull market began, and these tech stocks started exploding in terms of market cap. Nvidia hit a $5 trillion market cap just the other day, a couple of days ago last week. And that's because of all this enthusiasm around AI. There's a ton of spending going on, $370 billion between all of these companies spending with each other, that is driving both top-line sales growth and also profitability. But we have so much concentration in just these few stocks, it's a little bit worrisome for investors.
So let's take a look at market capitalization. It's not something everybody thinks about, but it's the size of companies. And over the history of America, the biggest companies have rotated. Some of them sometimes been pharma companies, oil companies, coal companies, industrial companies. Of all the stocks in the S&P 500, which is 500 stocks, 493 of them account for basically 2/3, 62% of the market. 7 stocks account for 38% of all the value in the stock market, in the S&P 500. These are the biggest of the big. 7 stocks.
Yeah, there's a lot riding on it. And the good news for investors is that you probably own these if you own an index fund or a mutual fund that tracks the S&P 500.
Yep.
The bad news is there's so much hope in that these companies will continue to produce these types of results. And the amount of spend that they're promising and that they're actually pledging mostly to one another is what's driving this right now. What investors want to know, what they're starting to worry about, the drumbeat's getting louder about a potential bubble here, is when does this turn into profitability for these companies? And if it doesn't, the entire stock market's kind of resting on the back of these companies.
So, Justin, there's 2 things. First of all, I want to ask you, seeing all that, what could possibly go wrong? And 2 is that it's AI companies, and you may really love AI on your phone, and I happen to believe that AI will help us solve some, illnesses that we haven't been able to solve. I think it'd be great. It's also going to replace a lot of jobs.
Yes, but So, look, we said the plough would replace a lot of jobs. And what happened was we restructured the economy in a way that people don't dig holes anymore. We use machines to do it. And we said the personal computer would replace a lot of jobs. And at one level it did. We no longer have secretaries, but instead what we have is a whole lot of knowledge workers. And we said that the spreadsheet would replace bookkeepers. And in fact, it did, but it led to a whole lot of new analyst jobs. So there's an optimistic story here, Ali, that you and I and the viewers at home are going to move up the value chain. We're going to do what's distinctly human and let others do what computers can do.
Caleb, you talk. I mean, our viewers will be enjoying if they've got a fund that looks like the S&P 500. They'll be enjoying the gains that they've seen. But you did mention something. You said there's some worry about a bubble. Talk to me about that. What does that? What does that look like?
Put this into perspective. Just to the rise of the stock prices of these companies, since that release of ChatGPT 3 years ago, Nvidia alone is up more than 1,000%. So there's a lot riding on the continued increase in share price for that company. But also, there's this concern about, are these AI companies, this big AI superstructure infrastructure, too big to fail? There was a lot of talk this week about all the spending that's going on among these companies. And at some point, if their revenue does not get produced from all the spending, if we don't see actual jobs produced and real revenue produced, are these companies going to need some type of a bailout? You're starting to hear a little bit of a drumbeat around that. Again, these are massive companies spending a lot of money and planning to spend a lot more. The issue is, when does this turn into real economic growth for the country? Because this is not job creation. This is pledges for hundreds of billions of dollars in spending. And if it doesn't come through in terms of producing results, what does that mean for the economy? What does that mean for the stock market?
Justin, if you go back to 1999 or 2000, where we were talking about tech companies in general and the dot-coms and things like that, and some people said, I'm not touching this stuff, it's crazy and dangerous, and others said, I'm backing up the truck and piling it in. By the way, you probably would have been right to invest in it, but you also probably would have lost a lot of money on things. This feels like that moment, that something's going to happen that's really big here. AI is not going to disappear, but for my viewer, how are they supposed to think about their exposure to it in terms of their 401ks?
Yeah, so it's funny. History sometimes rhymes, and this looks awfully similar. I'd caution you from thinking about only one analogy. We've had, an industrial revolution driven by steam. We've had electrification. We've had the invention of the personal computer, the invention of the spreadsheet, the invention of the internet. And so there are many historic moments to go back and draw on. I think what's useful about the dot-com boom is there's sort of two things that people are thinking about right now. One, we might be on the cusp of an utterly transformative technology that will change every part of the way we live and work. Two, it might be a lot of people in Wall Street are overly excited and in over their skis. And what we learned from 1990 and the NASDAQ bubble and then crash is actually both turned out to be true. Mm-hmm. The internet has changed our lives, but there was also a lot of excess and froth. The idea that you could found a company, pets.com, because pets can't drive, sending cat litter through the mail, and somehow the internet makes that profitable, was crazy. And the question is, are we seeing a modern day pets.com right now?
I do want to ask you about tariffs. You have done some work, Justin, on what tariffs, you can never track where the tariff situation stands with Trump, but how much that it adds to a person's bill. Donald Trump posted that he wants to give a dividend. He wants the federal government to use some of the money that they've taken in from tariffs and give a dividend of at least $2,000 a person, not including high-income people, will be paid to everyone. Your quick analysis on that.
Well, he's going to have to find some money from somewhere else. So there's 330 million Americans. If he gets rid of the rich, that gives us 300 million Americans. Ali, you're asking me to do arithmetic on national television. It's dangerous, but I think 300 million times 2,000 is 600 billion. That's more than he's going to bring in tariffs this year. So basically he's saying we've got the biggest budget we've had during a peacetime, non-recessionary period, biggest budget deficit. And you know what I'm going to do now? I'm going to throw more money at it. Throw more money out the window for no reason whatsoever. There's no economic crisis that demands that checks go out that right now. If he's worried that his tariffs are hurting the cost of living for Americans, here's a simple solution. Stop him. That's it. We'll stop complaining about him.
Justin is in Michigan. Caleb, you and I lean into the University of Michigan Consumer Sentiment Index. It's been around for about 73 years. We like to see whether it tracks what the government is saying, but it's an index of consumer sentiment, which it's gone to a 3-year low. In fact, we're at the lowest level since June of 2022, a 6% decrease from the previous month and about a 30% decrease from a year ago. Obviously, we need these numbers now more because we don't have government numbers, but what does that tell you?
It tells us that consumers feel terrible about the economy, yet we continue to spend. Now, are we spending more? Or are we just paying more due to inflation right now? This is not a great sign going into the critical fourth quarter here. Holiday shopping, obviously. We have the issues with travel, given the flight delays. So we got potentially a slowdown in spending going into the holidays, a slowdown in flying, the services part of the economy. This could be very bad news as we wind up the year.
Right. We talk a lot about flying as something that's going to affect people who are going around for Thanksgiving. But the reason there are 10,000 flights in the air every day is because people do their business in the air. Guys, thanks very much. Great to have both of you here. Justin, your math was actually right. My calculator doesn't calculate that big, so I'm glad that your brain is better than my calculator. Caleb Silber is the editor-in-chief at Investopedia. Justin Wolfers is a professor of economics and public policy at the University of Michigan, a senior fellow at the Brookings Institution, and the author of The Principles of Economics.